Good evening, ladies and gentlemen. This is Barry Norman on behalf of ETX, and welcome to our class on MACD, Moving Average Convergence and Divergence. Now, for those of you that haven't joined us before, ETX is a regulated provider, and therefore I'm required to give you a risk warning. So let me read that and get it out of the way. Trading in the financial markets can result in the loss of the amount invested. Do not trade with funds that you cannot afford to lose, and seek advice if you do not understand the risks. All information that's provided in this webinar is for educational purposes only. ETS Capital and the presenter are not financial or investment advisors, and we do not recommend any securities or instruments of any kind. And for those of you who are joining through an internet promotion and don't know much about ETX, we are a fast-growing financial services company based in London. We are authorized and regulated by the FCA, the Financial Conduct Authority, and we're also a member firm of the London Stock Exchange. When you trade with ETX, you can choose from trading on our binary options platform, which is great for beginners, where your risk is only the amount you type into the screen, and you simply have to predict whether an asset will go up or down. Or you can trade, if you're in the UK, you can do spread betting. Otherwise, you can trade CFDs with us or Forex. You can trade commodity stocks, indices, shares, whatever you wish. And you can trade either on our web trader or our ETX Trader Pro, which is one of the most advanced web traders, where you simply use a username and password and log in, and you have our advanced charts, our order entry, and all of your information stored right there. Or you can also choose to download our MT4 platform, and you can use it to automate your trading. You can use all the expert advisors on our platform, and you can also have it set up signals and alerts through the platform. It's up to you. Use all of them, none of them, whatever you wish. Customer support will be glad to answer your questions or get you set up correctly. Now, let's talk a little bit about moving average convergence and divergence, MACD. Now, I'm going to try to say this up front. First of all, tonight's class has been recorded. If you want to see another version of this class, just use the same link you used to come to this class and you'll see a recorded version. It'll be available in about 24 hours from now. Now, I've taught this class a lot of times. I use MACD for my own trading. I love MACD. But the fact is, it involves many lines, which each have different calculations. It's not very complicated, the calculations. But I think it's crucially important that everybody understand where each of these lines that are put on the indicator come from. Because that way you have a solid foundation. You don't have to know the mathematics, you don't have to do the calculations, but you need to understand each one of these lines. So sometimes when I'm trying to explain it to you, it gets a little wordy. It gets a little bit, it's not complicated, but it's just a lot of words. And sometimes you lose the point. There are all different places you can go on the internet and just look up MACD, not other people's strategies, not necessarily how to use MACD, but the basis of MACD. Investopedia has a great explanation. We'll take you through step by step on the calculations and development of each one of the lines that are used on a MACD indicator. So if you don't follow along, you get a little lost or I confuse you a little, I've tried it in different formats and different ways. It's just, like I said, a little bit wordy. So please remember this as we go through, because I'm going to try my best to get it across to you the best I can. Now, MACD was developed by Gerald Appel in the late 70s. The rather grand-sounding name, Moving Average Convergence and Divergence Indicator, is actually one of the most commonly used momentum indicators. So it falls in a category that we can consider momentum indicators. It is used to spot changes in the strength and direction of momentum and the duration of a trend of a stock or an asset's price. Now remember, when Appel developed this in the 70s, all you people were trading were stocks. No, there was some commodities trading, but it was through brokers, and there wasn't retail trading. But since then, it's been found that it works extremely well in the Forex market as well as for the CFD market. It works almost perfectly well in every market, in every financial market. MACD is one of the most popular and broadly used indicators in Forex trading. The letters MACD is abbreviation for Moving Average Convergence and Divergence. And it's a mouthful to say, so we just stick with MACD. The MACD indicator, which requires moving averages as input, fall into a group of the lagging indicators. The basic function of MACD Forex indicator is to discover new trends and help to identify the end of current trends. There are various ways to gauge the signals generated by MACD, and many traders use their own unique settings and methods for this type of trading. There are all different types of interpretations that you can apply. You can test it in many different areas. I use, myself, the standard calculations that were developed by Gerald Appel. I apply them in different formats because you'll see as we go along, you get different types of signals. Some I use very strongly, some I don't put so much strength in. Now, trading divergence is one of the most popular ways to use a MACD histogram. And we're going to go into detail on the MACD histogram. But unfortunately, the divergence trade is not very accurate. It fails more than it succeeds. To explore what may be more logical method of trading MACD divergence, we're going to look to use a MACD histogram for both trade entry and exit signals, and how currency traders are uniquely positioned to take advantage of such a strategy. Now, many people mix up or don't have a firm understanding of what divergence is. They think when an indicator diverges from each other, it's a divergence. Convergence is strictly when two lines cross each other. They come together. Divergence is much different. And moving MACD can be used for both convergence and divergence. So let me show you what a divergence will look like, and then we're going to go back to learn what MACD is. But I'm going to show you what a divergence is so you understand. If you look on this chart right here for Ethereum and the US dollar, pay no attention to prices. We're not concerned with any of that. We're not here to make a trading decision. What we can see is that the price currently is moving in a downtrend. But the indicator, and this is the MACD indicator, is moving in an uptrend. This is what is called divergence. When the indicator moves in an opposite direction or diverges from price. Convergence, on the other hand, with a MACD indicator is when one line, which is one's a MACD line, the other is a signal line, converge together or they cross over. Okay. So keep that in mind. So we have crossovers and divergences. So let's go back and let's talk about what all these lines come from that are on this little chart. So actually what we can see here is this is a MACD. All of this is MACD. We have a MACD line, a signal line, we have a histogram. All of this is what makes up the MACD indicator. So let's see where this all comes from to how it forms what we see on the chart. Okay, the MACD indicator is typically placed at the bottom of the trading chart in a separate window beneath the price chart. Hence, it's a technical indicator. Why? A technical indicator is anything that is placed on a chart. The moving average convergence divergence is a relatively easy to use tool. However, it is crucial to understand it fully before attempting to use its signals. The concept behind MACD is fairly straightforward. Essentially, it calculates the difference between an instrument's 26-day moving average and 12-day moving average of exponential moving averages. Of the two moving averages that make up the MACD, the 12-day, and remember, when we're talking about moving averages, we see 12 days. If you're using a 1 hour chart, a 1 day chart, it's 12 days. If you're using a 1 hour chart, it's 1 hour for 12 hours. If you're using a 15-minute chart, it's 12 of the last 15-minute bars. But because EMAs or moving averages were all based on daily charts many years ago, everybody refers to it as a 1 day, a 5 day, a 20 day, but it's a time frame moving average. Okay. Now, when you have a 12-day moving average, it obviously moves faster or reacts faster to the market than a 26-day moving average. So if we had these two lines on a chart, the 12-day would be more responsive to prices, where the 26-day would be slower and more, giving you a more overall trend movement. In the calculation of their values, both moving averages use the closing price of whatever period is being measured. Now, believe me, there's all types of people out there. There's all types of people that have adapted it and written strategies on how to use the opening price. Some use the average price. Some use a midday price. Some will use the high price for the day. This is all individual traders' strategies or their own customization, which you can do. But when you customize something, you have to do all the back testing, all the examples, because then it doesn't fit the standard. Okay, I use the standard, which is a closing price for a 12-day and a 26-day EMA. Okay. On the MACD chart, a 9-day EMA of the MACD itself is plotted as well, and it acts as a trigger to buy and sell decisions. The MACD generates a bullish signal when it crosses above its own 9-day EMA, and it sends a sell signal when it moves below its 9-day EMA. So if we were using strictly moving averages, like there's a lot of people that use a 10-day and a 90-day, or a 10-time period and 90, or a 10 and a 20. There's all types of strategies for simple or using moving averages. And when one crosses the other, it generates a signal. In the case of MACD, it goes a few steps farther. And that's why, if you noticed, we didn't have MACD EMAs or moving averages on our chart. So let's go back to that chart for a second. Okay, so you can see there is no on the chart moving average. Now we could plot on this chart a moving average by simply doing a weighted moving average exponential, and we can put that on our chart. And so we put it on our chart, and let's customize it now. Now it gave us a 9, so we're going to use a $12-period moving average. And we're going to make this broad, and we're going to make it a bright yellow so you can see it easily. Okay. So for our MACD, we use a 12-day moving average, and then we use and then we're going to put another one on here. And that will be our 26-day moving average, which is not necessary to place on a chart. Oh, come on. So we're going to take our second one, and we're going to make that, let's pick a bright color. We're going to make that bright, whatever color that is. And we're going to make that a 26-day moving average. So now we have a 9-day, a 12 period moving average and a 26 period moving average put on our price chart. Now, we could just use those alone as moving average strategy. MACD takes it a step farther. Because as you notice, this was not part of our MACD. But these two lines are then calculated into the lines we see below. Okay. So let's first see how we do this calculation. So let's go back to the PowerPoint. Okay, so first we have our 9-day and our 12-day moving average put on to our chart. Okay. The moving average used to construct a MACD can be simple, weighted, or exponential. The standard is using an exponential. Although they work, the exponential is preferred. The MACD is perhaps the best all-round study. Indeed, we consider the MACD to be the best single oscillator available. Now, what we do then is once we have these two on to the chart, and because we don't use them on a chart, we do the calculations, and the computer does the calculations. Okay. What we do is we then subtract one from the other. So in other words, at this price here, we have two different moving averages, okay? And we simply subtract one from the other. When we do that, we plot that as a single number on our chart below. So the line below is simply the difference between the two moving averages. And this gives us our MACD line on the bottom of our chart. That's one of the lines. Okay. Now, once we have our differential line, which is called our MACD line, we then put on what's called our signal line. Our signal line is simply a 9-day or 9-period exponential moving average of the MACD line. Okay? So what you've done is you've taken this red line that we put on the chart, and we've taken 9 periods and averaged them together, and we put a second line on the chart, which is in this case, the blue line. Okay. And that gives us what's called the MACD signal line. Now, if we ask, remember we were talking about crosses, and we talk about how the 12 would be faster reacting to the price than the 26. So, in common sense, or if we in standard mathematics, if the 12-day and the 26-day move together or converged, what would the difference between the two lines be? The two lines would then be 0. So we have a 0 line put across our indicator. Every time the MACD line, the red line, falls above or below the 0 line, or whenever it touches the 0 line, tells you the two moving averages that were on the chart are now together. Now, if the 26-day moving average moved faster past the 9-day moving average, the difference would then, as it moved up, be a positive number. If it was smaller, and because it crossed down, it would become a negative number, correct? So hypothetically, if the moving average here was say it was gold, and gold was at 1250, and the moving average is 1250 on a 9-day moving average, and 1246 on a 26-day moving average, the difference would be 4, correct? So we would have plotted a 4 on this chart. When the longer term moving average in 26 moved to 1251, but the shorter term stayed at 1250, what would the difference be? It would now be a -1. So at some given point, to fall from the 4 to the -1, it had to have crossed over and gone over the 0 line. And when it crossed over into the negative, it gives you a buy or a sell signal if you were just using the moving averages. Now, if we were just using moving averages, whenever we would get a crossover above or below, it would tell us to buy or sell if you're just using moving average. But a MACD, we've now got the red line, and the red line is the difference between those 2 points, and every time it crosses the 0, we know that these 2 moving averages are crossing one another. Now, when the signal line, this blue line, which is called the signal line, it becomes a 9-period or 9-day moving exponential moving average of this red line. So in other words, if the difference between gold at this point was 4, then it fell down to -1, what would the moving average be? 12 to -1, it would be 5, and the moving average would be 2.5 or somewhere about here. And that would be where we would plot the blue line. So therefore, we have 2 lines on our chart, and they are both falling above and below 0. So MACD can be helpful for noticing potential changes in trend at very early stages of a currency pair's move. However, if we wait for the 0 line crossover, MACD crosses the 0 line, we are essentially trading a moving average crossover, okay? Which is inherently lagging in the market and may not be the optimal point of entry. So this is why we're not using just a simple moving average crossover. This is where the signal line comes into play, the blue line, which is the 9-period exponential moving average of the MACD line down here, or the differential. The signal line is simply a moving average built on the value of this MACD line, and by default, the value is commonly set at 9 periods. So what do we have? And this, remember, I apologized in the beginning that this is very wordy. We started out with 2 moving averages, a 12-period moving average and a 26-period moving average. We could have left those on the chart, and it would have been nothing more than a simple moving average crossover strategy. We have 10 and 20 day, we have 30 and 90 day, we have 6, we have one that's based on 30, 60, and 120 day moving average. MACD takes a simple moving average crossover strategy and moves it farther. What it does is it takes the difference between those 2 moving average lines, which is very simple to understand, because the moving averages there's a difference between the 2 moving averages. When you plot them on a chart, you have numeric values. You simply are going to subtract those numeric values. When those numeric values are crossing over, they must cross the 0 at 0. Because when one goes over the other or one goes under the other, they are both the same number. So therefore, when you subtract gold at 1250 from gold at 1250, you get 0. So whenever it crosses the 0 line on the chart below, we know, what did we know? We know we just got a crossover. So we don't have to look at these 2, because we know, based on the difference between those 2, that we got a crossover. And whether it's above or below, we know which line crossed the other, whether it's above the zero or below the zero. So we then add a new line or another line that comes into play, which is this blue line, which is a 9-period moving average of the red MACD line. So what we've done is we've added one more level of study into this simple moving average crossover to start moving it into a more important indicator. So building on the relationship of the MACD line itself, traders will often look for entry points when the MACD crosses the signal line. So in other words, we look for an entry point at the zero line. Make sense? Because it's a crossover. Now when the MACD line crosses above and over the signal line, it is looked at as a buy signal. So in other words, whenever the red line crosses the 0 point, that tells us it's a crossover and we're looking for an entry. When the MACD line crosses above and over, the MACD line is the red line, crosses above and over the signal line. The signal line is the blue line. It's giving us a buy signal. When the MACD line crosses below the signal line, it's giving us a sell signal. Everybody follow me. Like I said, I know it's wordy. I know it's complicated. It's not complicated. It's just a lot of words. So let's go back to my charts and see if we can give this a little bit of a break here. So let me make these a little bit easier for you to see here. So that's not where we're going to get to the histogram in a second. The MACD line, we're going to make a dark blue, and we're going to make it very thick. Okay, see that on the bottom now? It's dark blue and thick. We're going to make the signal line, we're going to make it gold, and we're going to make that very thick. Let's see if we make it thicker. Okay, so what we see is we can see we've made, actually let me make it red because we've been using, let me make it the same colors we've been talking about in class. So the MACD line will go back to being our red line. I'm going to hit the histogram, and we'll make the signal line back to being our blue line, because then it makes more sense because it's just like we were talking in class. Okay. So now we have this MACD line. Actually, let's put the 0 line on here so it's pretty easy to see also. Oh, why won't it go on? Okay, let's put the 0 line on here. Okay, and so I just plotted for you the 0 line. I'm trying to get as close to 0 as possible. That's the 0 line. Okay, so this is our zero line. Our blue line is what? Our red line is what? Our red line is the MACD line. The blue line is the signal line. So what we're looking for are crossovers above and below between the blue line and the red line. Because if you notice on the chart here, we had a crossover right here. Why? We also had it at zero. Because the crossover will effectively be the same as the zero, as I explained to you, because the price has to be is equal to zero when they cross over each other. So here we had another crossover. Here we have another zero crossing on the line. Now, what we would be looking for to get a buy or a sell signal or an entry signal is the crossover point between the MACD line and the MACD signal line. So we're looking at it to come off the zero and then see where it crossed. So where these two cross each other give us buy and sell signals. But it gives us a lot of buy and sell signals. Okay? And therefore it could give us a lot of not bad signals, it'll give us a lot of not highly profitable signals. Because if we look at each place this signal generated, it was correct and the asset moved in that direction, but sometimes it just moves a couple pips. Sometimes you may not cover the spread. Okay. So you need to factor out which are strong or good entry signals. The entry signal is not incorrect just because you wouldn't have made many pips, but you only want to make or use it for when you can make the most pips. So one of the things you want to watch for is the crossover when it is closest, when the red and the green line cross over closest to the zero line. The farther away, the less intense that signal could be. Because look at all of these crossovers that we get. But this one, right about there, would have been about the best you could have gotten. That was the end of the uptrend. And look at how this fell way down here. Now, it broke the zero. But so we need to be able to factor out a lot of the buy and the sell signals. So let's go back to the PowerPoint and talk about this a wee bit more. Sorry about this. Let me get my marker off. Okay, so remember, when the MACD line, the red line, crosses above and over the signal line, it is a buy signal. When the MACD line crosses below the signal line, it is often looked at as a sell signal. So this is the general rule of thumb. So in an effort to more closely follow the relationship between the MACD and the signal line, traders can follow what's called the histogram, which is simply a bar chart plotted around the zero line to indicate the relationship between the MACD and the signal line. So when the MACD crosses the signal line, the histogram will cross the zero line. So now, instead of we're talking about the zero line being crossed by the red line, we're now talking about the difference between the MACD line and the MACD signal line that we've already plotted on the bottom of our chart. So when we can then subtract these from each other, when those two become zero, that means they just crossed. Okay, so the histogram will approximately cross the zero line. When the MACD crosses up and over the histogram will climb above zero. When the MACD crosses down and below the signal line, the histogram will drop below the zero line. So when the MACD crosses the signal line, the histogram will cross the zero line. The histogram is this bar chart, these green colors put on the chart. The histogram is the relationship between the MACD, the red line, and the MACD signal line, the blue line. Again, when it's plotted on that zero line, when it is zero, those two lines are now crossing each other. So actually what we're dealing with is a four-place derivative from the original charts. So watch the histogram. Okay, we can see when these two lines crossed each other, right here. Where's the histogram? It's at zero. When these two lines crossed each other here, the histogram is at zero. When they crossed here, it's at zero because it must, in order to cross, they must at some point have been equal to each other where they are separated. So let's go back to the chart again. Now the first thing we're going to do is if you're using MACD, you want to get rid of the EMAs, the moving averages on your chart, because you have to not rely on those. You need to learn to read it on your MACD chart, because otherwise you're getting confused because you're not getting double the signals. What you're getting is your red line is simply the explanation or the mathematical variance of those two lines above. We go one step farther, one more derivative, and we're going to add on here the MACD histogram. Well, I took it off, and let's see if there's an easier way for me to put it on here. Oh, yeah, I know how to put it on. Here. And we're going to make the histogram in gold so it's easy to see. Nope, can't see that too well for you guys. Let's put it in okay. So this is the histogram. The histogram is a bar chart. See the bars going up and down? The histogram is the explanation of these two lines above. It is the difference between the two lines, the MACD signal line and the MACD line. So we could simply get rid of the MACD line and the MACD signal line, and now we can completely rely on this histogram that has now broken down and calculated all of the differences of the moving averages and their movements. And it's all given to you in this simple little histogram. Now, most people don't take it to the bare basic histogram, but you can. And this is what you should be able to look at this histogram and be able to tell the whole entire story of the moving averages and price movement. And if you look, these moving averages, this histogram bars also move in kind of conjunction with price movement. But in order to see convergence and divergence, we need to keep the other two lines on the chart. So we're going to put them back on the chart. And let's talk, actually let me move this up a little bit, see if I can make it bigger for you. There we go, now we can just see it a little bit better. And let's go talk about this histogram. Okay, so now MACD gives us three different stories. There are three popular ways to use moving average convergence and divergence. One is crossovers. Two is overbought and oversold conditions. And three is by divergence. Okay. Crossovers. The MACD trading tool rule is to sell when the MACD falls below its signal line. Similarly, a buy signal occurs when the MACD rises above its signal line. So in other words, we can see on this chart what do we have? When the MACD line, we have a sell signal because the MACD line fell below the signal line. So when they crossed over, that generated a sell signal. Now, we're not looking at the moving averages on here. We're looking strictly at the crossovers from the MACD line. Here, what happened was the MACD crossed above the signal line and gave us a buy signal. Right here, it generated a buy signal. Here it generated a sell. Here it generated a buy. But if you kind of look very carefully at the histogram below, okay, at the 0 was the crossover, and these two crossed. It had to be 0. When it fell below, it told you it crossed below. It gave you the sell signal. So it's all compacted into this histogram. So when you have these simple crossovers, it generates buy and sell signals. So in other words, whenever the MACD histogram is at 0, it's generating a signal. If the signal falls below, it's generating a sell signal. If it falls above, it's giving you a buy signal. Okay. So you can use either the crossover lines on the chart, on the bottom of the indicator, or the histogram. So we can see how each one of these crossovers, or each time it hit the 0 on the histogram, it generated a sell or a buy signal. So here we got sell signal, sell signal. What happened? We would have sold at this point. We would have made profit to that point. Here we would have sold and we would have made profit to that point. Here we got a buy signal. The histogram hit 0 and then traded above. We would have moved to the uptrend. Here we got another buy signal. And each time the MACD line was very accurate, generating the proper signal. But it's generating a signal. You have to do more or use additional indicators to figure out if it's worth trading. Now also, MACD will also give you overbought and oversold indicators. When the shorter moving average pulls away dramatically from the longer moving average, in other words, the MACD rises, it is likely that the symbol price is overextending and will soon return to more realistic prices. So when we see a large climb in the MACD line, not the signal line, it's telling you the asset is overbought, okay, or overextended. If you have the reverse, a big fall, it's telling you the same also. It's either overbought or oversold conditions. It is not used often for that, but you can use it. Now, one of the most important signals, or one of the most reliable signals, is called divergence. An indicator that an end of the current trend may be near occurs when the MACD diverges from the symbol. A bullish divergence occurs when the MACD, Convergence Divergence indicator, is making new highs while price fails to reach new highs. A bearish divergence occurs when the MACD is making new lows while prices fail to reach new lows. Both of these divergences are most significant when they occur at relatively overbought or oversold conditions. So let's go back to our chart. And that's why this is so important. Here we have an absolutely perfect divergence. We have the MACD line, or the MACD, yes, moving upward, showing a strong upward indication, and a trend line or price movement in the exact opposite, making lower lows while the other one is making lower highs. So you have one moving towards an uptrend in an upward signal and one moving in and down. That is telling you it is a definite signal to enter or exit a market. Now it has to be, we also got a crossover here. We got signal from the divergence. We got a signal from the MACD and the MACD signal line, or on the histogram we had a crossover to zero. So it is telling you what? Is it a buy or a sell? Well, you'd have to use the crossover here, and what happened was the MACD signal line crossed over the MACD line, but right now we're getting another crossover, and we won't see which way this is going to go until we see a second from now. But that's going to give you a definite entry point into a trade. So how are the three ways we can use MACD? We can use MACD in convergence, divergence, or overbought and oversold conditions. So bearish divergence, a bearish divergence forms when a security records higher highs and the MACD line forms lower highs. Okay. So in other words, when we see the MACD line making lower highs, but the price is making higher highs, we have what? We have a divergence. It is a bearish divergence telling you that the trend is about to end, and we can then use other indicators to determine this, to make a final approval, but it's telling you something. So a histogram, and if you can learn to just rely on your histogram, the histogram is an indicator of an indicator. In fact, MACD is also an indicator of an indicator. This means that the MACD histogram is 4 steps removed from the price of an underlying security. In other words, it's a fourth derivative of price. The first derivative is the 12-day moving average and the 26-day moving average. Then we do that to the second day, which forms the MACD line, which is the 12-day less the 26-day. Then we go to the third line, which is the MACD signal line, which is a 9-day moving average of line number 2, or the second derivative, which is the MACD line. And then we go to a fourth derivative, which is the MACD histogram, which is the MACD line less the MACD signal line. The base for the indicator is the securities price. It takes 4 steps to get from the actual price to the MACD histogram. Talk about massaging data. While not necessarily a bad thing, chartists should keep in mind that when analyzing the MACD histogram, it is an indicator of an indicator. Therefore, it is designed to anticipate signals in MACD, which in turn is designed to indicate changes in the price momentum of the underlying security. As with MACD, and the MACD histogram is also designed to identify convergence, divergence, and crossovers. So it will generate good buy and sell signals. It will generate warnings that the market is overbought or oversold. It will also generate signals telling you that the trend is about to end. Okay. You have to spend a little bit of time, but it's not very complicated. It's a very straightforward indicator. But the biggest disadvantage of using this indicator to generate transaction signals is that a trader can get whipsawed in and out of several positions before being able to capture a strong change in momentum. As you see in this chart, the lagging aspect of this indicator can generate several transaction signals during a prolonged move. And this may cause the trader to realize small, unimpressive gains and even small losses during a rally. So use them to generate your entry signal, but use other indicators to confirm, and then figure out where your target could be and where, if there's enough movement in that asset, and what your risk reward potential is, to decide whether you want to enter the market. traders should be aware that the whipsaw effect can be severe in both trending and range-bound markets because relatively small movements can cause the indicator to change directions quickly. The large number of false signals can result in a trader taking losses. When commissions are factored into the equation, the strategy can become very expensive. So use it as a signal line to generate signals. Use it for sure as a trend reversal indicator, but combine it with other indicators and other methods to determine if that trade would reach your support, your risk-reward potential. Just because it generates a solid signal doesn't mean it's a signal that will make you enough profit to stay in the markets. So another MACD's drawback is inability to make comparisons between different securities. Because the MACD is the dollar value between the two moving averages, the reading for different price stocks or assets provides little insight when comparing a number of assets to each other. So the MACD indicator is the most popular tool in technical analysis because it gives the traders the ability to quickly and easily identify short-term trend direction. The clear transaction signals help minimize the subjectivity involved in the trading, and the crossover of the signal lines make it easy for traders to ensure that they are trading in the direction of the momentum. Very few indicators in technical analysis have proved to be more reliable than the MACD. And this relatively simple indicator can be quickly incorporated into any short-term trading strategy. And with that note, guys, I'm going to say goodnight to y'all. Thank you very much for joining us today. I hope you learned a little bit about MACD. And believe me, if you use the standard MACD, learn to read the histogram, you can incorporate that into any trading system. But it will give you good, honest entry, buy and sell signal. And for me, the first thing I want is an asset to give me a buy or sell signal. I can then quickly do my other strategies and incorporate it into my trading plan and decide if I'm going to enter and exit the market. But you need something to tell you that something's about to happen in the market. So thank you very much for joining us. We'll see you on Wednesday and have a great weekend. Bye now.